Hello, I'm Professor Hewen, and welcome to Intermediate Accounting. In this video, we're going to review what to expect in intermediate accounting, the importance of financial accounting and reporting. We're going to review the balance sheet and the income statement. Make sure you have a pen and paper or a computer where you can take some notes on as we go along. You previously took financial accounting, the introductory financial accounting class. Intermediate is very similar, except we go into a lot more detail. Remember, the introductory financial accounting class was for all business majors. Intermediate accounting is required for accounting majors. So we're going to get into a lot of the details of generally accepted accounting principles that you didn't cover in financial accounting. Perhaps the biggest difference you're going to see between this class and the introductory class is the pace of the class. We're going to cover a lot more, a lot faster than we did. Intermediate accounting is a two-sequence course, so it's Intermediate 1 and Intermediate 2, and that's not even all of the information for financial accounting. There's also advanced accounting that's required for accounting majors. All of this is in hopes that after graduation, you'll be studying for and passing the CPA exam. Financial accounting and reporting is one section of the four-part CPA exam, and we're hoping that this knowledge that we're giving you in the undergraduate is going to build a strong foundation for you to then continue your studies after graduation and get through the financial accounting and reporting section of that CPA exam. Financial accounting is the study of generally accepted accounting principles, as you know from your introductory class. We're going to revisit many of the rules that you went to before and go into much more detail. Our textbook here is about 1,500 pages, and that does not include the appendix. Why is that? Because GAAP, there's a lot to GAAP, and we need to become experts on GAAP. Now, if this looks like a lot to cover in one semester, don't worry. We actually have 2 semesters, Intermediate 1 and Intermediate 2. So tell your roommates, tell your family that you can't be bothered for the next few months. Cancel that Netflix subscription because we have got a lot to do. Here's our semester in a nutshell. We're going to review the accounting cycle, go through the income statement and the balance sheet in more detail than you've seen before. We're going to go through the details of cash, accounts receivable, notes receivable, inventory, plant, property, and equipment, and intangible assets. Sounds pretty simple, right? Considering that you've done all of this before. But remember, this textbook, it weighs more than my daughter did on the day she was born. Financial accounting allows us to prepare, report, and understand financial information. And what's so important about financial information? Well, companies, organizations that are operating, they need cash. How are they going to get that cash? To hire people with great ideas, to pay these people, to develop new products and new services, to advertise. There's 2 primary ways that these organizations can get cash. One is from the bank by taking out loans, and another is from individuals all across the globe that are sitting on cash, don't want to invest in the bank to have a 1 or 2% return on a savings account. So we need to match up the banks and the investors with those companies so that each of the 2 organizations, the banks and the investors, can give their cash, and the companies can give a promise to repay with interest to the banks, and the companies give ownership interest to the investors. And this helps facilitate our economy. The bank is better off, they're earning a return, investors are better off, they're earning a return, and the companies or organizations are better off because they're getting the cash to run their businesses. But how does the bank know, and how do the investors know which one of the organizations or however many of these organizations their cash should be given to or lent to? They need some information about that organization in order to determine how is it performing and what's the likelihood that they're going to get repaid or invest in a company that has some net worth to it. That's where financial reporting comes in and what financial accounting is all about. Provides financial information, so information in dollar terms, that's useful to current investors, prospective investors, lenders such as the bank, and other creditors. In making decisions about providing resources, or in other words, in deciding, should I give my cash or lend my cash to this organization? Now, if you look at the business news, you'll see a lot about earnings. This is just of critical importance, how companies are performing in terms of earnings. Why is that? Well, earnings are often used as a metric. Previously reported earnings are often used as a metric to estimate a company's current stock price and future earnings. Here we see an article about Chipotle. Chipotle is expected to report net income of $7.8 million or 23 cents a share. And the article concludes the stock price has risen about 44% since the company last reported its quarterly earnings. It's the fact that earnings are so critically tied to stock price that we need to understand what's behind those earnings and what's behind the rest of the financial information that might be coming out in those financial statements. When we say earnings, typically we mean earnings per share. And we saw that here with Chipotle, 23 cents a share. So we take that net income and we divide it by the number of shares of common stock outstanding. Why do we do that? Well, that helps us to control for size. Larger companies are expected to have more income, but we scale for size by using number of shares of common stock. Let's take a little bit of a look into the income statement. The income statement primarily is shown when we say earnings, and we're not talking about earnings per share. We're talking about net income, or in other words, your revenues minus your expenses. Here's just a basic single-step income statement. Remember, common expenses, depreciation, utilities, rent, salaries, insurance, interest, income taxes. And then you're left with net income, how that company performed over a period of time, whether that be a day, a week, a month, a year. Typically, when we're looking at publicly traded companies, we see their earnings quarterly and annually. Here's Nike's income statement. These numbers are in millions, so we see that for the most recent year, which ended May 31st, 2020, Nike reported revenues of $37.4 billion, and they break down their expenses into several types: cost of sales, demand creation expense, which is just a fancy way of saying advertising expense, operating overhead expense, that's all their other administrative expenses, selling administrative expenses, interest expense, other expense, and income tax expense. What remains is the net income of $2.5 billion. That belongs to the investors or the stockholders. They don't necessarily get that in cash. Most of that's going to get reinvested in the company, but remember, it belongs to the owners of the company, the investors. Let's take a quick look through the balance sheet. Now, what does Justin Bieber mean in the song Intentions? What does he mean when he says full of equity and you're an asset? Well, let's take a closer look. Here's the asset section of the balance sheet. The asset section is, what is the company working with? They want to produce income. What are they working with to produce that income, to generate the sales and the income? Primarily, we're talking about the cash, the inventory, the work in process, the raw materials, the finished goods. We're talking about their plant, property, and equipment, and maybe they have some intangibles. So assets, what is the company using to run its business, make its products and sell to the customers? How about liabilities? Liabilities are what the company owes. These might be the amounts owed to suppliers, unpaid wages, salaries and bonuses for employees, loans and interest owed to the bank. How about equity? Well, we can think of equity as if the company sold all of its assets for cash, then took that cash, paid off all of its liabilities, paid off the loans, paid back the employees whatever wages they were owed, paid back the government for any taxes that are outstanding. All of the liabilities were paid off. What remaining cash that is what the ownership or the net worth of that company is. We call the stockholders' equity or shareholders' equity or owner's equity, we call it a residual interest. It's one slight measure of what the company is worth at a point in time. All right, here's your basic balance sheet. This is a classified balance sheet, so we have our current assets separated out from our long-term assets, in this case just plant, property, and equipment. We have current liabilities stated separately from long-term liabilities. In this case, the one long-term liability is mortgage payable. We have the two main components of stockholders' equity. Remember from your introductory class, common stock and retained earnings. Here's the balance sheet of Nike in their most recent set of financial statements. As we can see here in the assets section, what's interesting is that Nike has $8.3 billion. Their biggest asset investment is not inventory, as you might expect. It's not plant, property, and equipment, as I had expected. It's actually in cash. They're sitting on $8.3 billion in cash. That's cash they're not using to grow their operations, to buy other brands, to create more factories, and open up more stores with that they're going to purchase. They have their biggest asset investment is in cash. Their next biggest asset investment is in the combination of plant, property, equipment, and operating leases. So the facilities, the plant, property, and equipment that they both own or have a contractual right or a lease on. And then their third biggest asset investment is in inventories. Those second two are not very surprising. We look at their liabilities section and we see that their biggest liability is in long-term debt. That's not too surprising. And when we look at, so if we take the asset side on we see the asset section on one side of the balance sheet. Nike has $31 billion in assets. The other side, the right-hand side of this balance sheet tells us how were the $31 billion in assets, how were they financed? They were financed partly by debt or liabilities. We see, well, we don't see a total here for the debt, but it looks like it's about 14 billion, and we see 8 billion in stockholders' equity. So those assets are primarily financed with liabilities, but also financed with stockholders' equity. To conclude this introductory lesson, we discussed investors and the importance of financial accounting for investors. We briefly covered earnings per share and how that measure relies significantly on companies' net income. We talked a little bit about net income, what's behind that number. Generally, we spoke about assets, liabilities, and equity, and we provided an overview of intermediate accounting. The next class, the next video, we're going to jump into the accounting process and journal entries.